inflation is still very much a risk. You don't know what you don't know in a lot of cases, but you're also willing to take more risk when you're younger. In the residential world, when your residents aren't able to pay you because they don't have jobs and everything else that they're trying to buy has become more expensive. And take some of that money and invest it in yourself.
They're winning, they're making money. What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amolsch. As you know, we're having so much fun with this podcast, speaking to guests, doing these solo episodes. I have a special guest with me today. I know you're going to get a ton of value out of this one. If you're out there investing in real estate, fixing and flipping, building a rental portfolio, or you're out there providing education to real estate investors, this is the podcast for you. So, Sam Morris, you are one of maybe two handfuls of people that I've talked to on this show that can compete with the amount of time and experience I have in this business. So you have it sounds like 20 years in the real estate investment business. I just learned that you sit on the board for a bank and you have a lot of experience in the lending to real estate as well. A lot of multifamily, self-storage, a lot of syndication, so raising money, managing money, lots of experience. So I'm excited to have you on the show. Welcome to the show, man.
Kevin, thanks so much. Yeah, I appreciate it. It's the benefit of having some gray hairs right at this point, right?
20 years, that's no small feat. I know because I've been in 20 years, I know what you've been through. Okay. I know you probably started shortly after the dot-com crash, but definitely before the global financial crisis of 2008. So we probably have quite a bit to talk about. But take me back, man. Back 20 years when you were young and excited and motivated and you're getting excited about real estate. What got you in?
Man, yeah, it's so funny because I started in the banking world, right? I started as really just a grunt analyst, and so right out of college, I had my finance degree, my management degree. I had all these degrees. I was really really smart and figured out really quickly that they don't let you be the CEO right from the start, right?
Yep.
That world hits you right at the beginning, and there you go. No, no, no. You're going to start at the bottom, and you're going to start to learn, and so. What was really interesting about that and that upbringing too, which, my gosh, I'm so thankful for it now. During the time I wasn't, is all I did all day, every day was underwrite. So I literally was just underwriting deals all day. I mean, for years I was doing that as I was learning and trying to become a lender on deals. And the education that I got, the real world education I got from that was really what opened my eyes into real estate. And really what that was is I had access to everything. So think about it. I mean, I see this guy over here who goes and buys a multifamily complex. I do all the underwriting for the deal. I get the rent rolls. I do all the things that a lender would do, right? And we always say our lender is our biggest partner, and
Mhm.
typically that's what happens, right? The lender is typically coming up with more than 50% of the money in the deals, and so they are the biggest partner in the deal. But I got everything. I got to see how that person did things. I got to see how much money they made personally from these things. And I was like, my goodness, like that's really interesting over there. And so
Yeah.
um, it was about 2007 that I started finally go, all right, I'm going to put my own money into these things. Like I know who all the players are, and I've talked to all of them, and I'm going to see who's going to let me come in and invest into a deal with them, right? And so I had picked my sponsor, and we figured it out and picked a deal, and I was all really really excited, ready to go. I'm in my 20s, and came up with $50,000, which was a ton of money to me at that time, and put the money in the deal. It was here in Houston, Texas, and about a month later we just got blown out by a hurricane and the property just
Oh
got
no.
destroyed. And you sit there and you go, oh my gosh, did I just lose everything? I knew everything from a quantitative perspective, from a pro forma perspective. Like I had this thing ready to go. Like I knew exactly how it was going to respond. And one act of God within, 4 weeks of ownership, just everything's out the window. And guess what? The learning curve really started from that, right? I mean, I learned everything you ever wanted to know about insurance. I learned everything you ever wanted to know about dealing with construction people. I learned everything you wanted to know about the laws associated with when you are a housing provider, how you still have to provide housing to your residents. And it was an amazing thing because that learning curve just became tremendous. And it was so much more than what I had ever experienced at that time. And, to fast forward just a little bit, it ended up working out really great for us. I mean, we had brought a property that we had paid the correct amount for, if not really a great amount for. And we had a big budget that things we were going to do to the property to enhance the value and things of that nature that our insurance company effectively came in and was able to do for us, right? Because the property was destroyed that way. And what was even better is the residents that were displaced out of that, because we went from 100% leased to 12% leased overnight. The residents that were displaced there were so happy to move back to their homes. And when they got to their homes and realized everything's brand new, right? I mean, it was new roofs, new ACs and things they couldn't see, but it was also new flooring and new cabinets and new carpet and all the, new paint. Everything was new to them. And they were so happy to be a part of that, and willing to pay more because of it. Right. They got all new appliances. They got all new everything. So it was a great, wonderful upgrade for them in their lifestyle. But one of the things that taught me, um, was, wow, this is really interesting. Within 12 months of us doing all of that, we refinanced the property. And when we did that, we were able to pull all the equity out, still paying ourselves distributions, but we got all of our money back. And that was another light bulb moment going, oh my word, this really is something that I want to keep doing because I've now created a cash flow stream that's coming in. I have all my money back, which is somewhat a unique situation. And I mean, it was an act of God that helped us get there. And I've learned so much more now, um, that this is something that I can really see myself doing more and more of. And so that's kind of the origin story of how it really got started, because it really got started out of a lot of adversity, and a lot of I have to learn how to do some of this stuff. And oh my gosh, did I lose everything? To recognizing, oh no, there are absolutely steps you take. There are people that have battle scars, that have understanding of how you're going to get through all these things. And really what that did was it set me up, because that was, 08, 09 at that point. You have a crash in the financial industry, and I'm all too excited to start investing into deals still, right? At a time frame where everybody is leaving and running for the hills.
Yeah.
And from a perfect timing of being able to go, yeah, let's go invest. It really couldn't have gotten much better, because when everybody was leaving and I'm like, no, 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 this is great. And here's why I can show you how it was going to work. Um, it was the absolute just great time to be jumping in and going, yeah, let's go for it, because you were able to buy things at, just significant discounts, which enabled us to, really benefit from, the upswing from from where that market was.
Yeah. I remember those days.
Yeah.
Very, very good. I was a little bit different, I think. I had a bit of a head start on you. I had my first rental property at 2003.
Yeah,
So
as did I too. I would say from rental properties, but for commercial, like when we started
oh,
doing.
gotcha, gotcha. Okay, because I was gonna actually dig into the project. So like most people go from like maybe a little condo, and then they might have a single family, and then a couple of and then a duplex, and they sort of
I did one
progress.
rental and I was like, no, I need
You're,
scale. Like
you're
you got
going
to go
right.
big. Guys who are making it are going big, and I'd rather pool my money with others and syndicate into a bigger deal, and
Yeah,
try it that way. And so I tasted it just for a little bit, and then I was like, no, let's go big. But I was, probably 26, 27 years old, whatever I was then, and going, yeah, this is, you know, you don't know what you don't know in a lot of cases, but you're also willing to take more risk when you're younger. So
you put your graduation cap on very
I did.
early. You
I
got
did.
out of the resi and got into the commercial quickly. So that first, it sounds like it was an apartment building.
It
Obviously,
was.
how big? How many units was that?
It was 100, just over 100.
A
So
100 units was basically your first deal. You had one rental property prior to that, but really no real experience until you enter this 100 unit. 2007, it's complete disaster. And then you hit the financial crisis and you still kept going.
yeah, well, I mean, it was the thing, because you could see the model of it, right? And that was the thing from having such a great understanding of the quantitative side of it, right? Being able to build out pro formas, understanding how markets work, understanding who the good sponsors were and how it would operate out of things. But really, what it came down to is, and the reason why I like multifamily so much was, you know, it's a necessity. You got to have four walls and a roof. Everybody does, right? So it was one of those things that I knew, people weren't going to cut, right? As terrible as it sounds. And, the financial crisis, we talk a lot about it, right? It was way worse than what we've, just recently gone through. I mean, it was
Oh yeah.
not like what we've had. I mean, I chuckle because there's so many guys who are like, oh yeah, this is probably just like, that '08 timeframe. I go, no, not
Mhm.
even close. Like, you'll have downturns. There'll be ups and downs and cycles in markets, but that was like the financial crisis. You have to understand when lenders are like, we're done, we're not lending anything, stuff stops, right? I mean, that's just you're having to go find alternative sources that, could be much more expensive, could be much harder to get it, much different valuations. And so when you're going in and negotiating it, that's why the buy opportunities ended up becoming really substantial for us, because to sell, really, the valuations of everything just had to come down drastically. And even when they did, you still had to find a lending partner who was still willing to do it, which most of them were not. And so that's very different than where we've been in the last few years. The lending really hasn't stopped. I mean, it may have adjusted. I mean, instead of loan to values being at 80%, let's just say maybe they're down to 65 or something of that nature. So you're having to come up with more equity, but it's not like they've cut off and said, we're not lending.
Right.
Back in those days, they literally cut off and said, we're not lending anymore. And so it was just a different time frame through that cycle.
Yeah, and to put it into perspective, Sam, there was over 500 bank failures in that time, and the largest bankruptcy with Lehman in U.S. history.
Hmm.
That's very different than what we had now. Now, and that this was the only recession. You probably know this better than most, but most recessions don't impact real estate and especially housing. In fact, there's recessions, many of them actually, where real estate values went up. So 2008 was unique, but it was housing that put it into the recession, and more specifically, the lending against housing that did it.
Yeah, the
This most
mortgage-backed
recent,
security market for sure was
exactly.
something that just, it blew up. But I mean, when you're sitting there and the way they package loans, and I don't want to get too complex, right? But yeah, I mean, there was a lot of greed associated with it and a lot of leverage that just was getting out of control.
Yeah, this is very different. This is more caused by government stimulus, which turns into inflation, which turns into higher interest rates, and that's what put us into our little tailspin we're in now. But it doesn't resemble 2008 at all. It actually more resembles a savings and loan coming out of the rapid appreciation and then the double digit interest rates in the 80s. So
Correct.
if you want to look at a different recession that more mirrors, it's 80s.
Yeah, the hope would be we're not going to get anywhere
We're
near
not. We're
rates at
not.
that point, right? But I did have some people ask me about rates the other day, and I just said, it kind of actually. I mean, I know everybody's like balking about it, but it's feels kind of like a normal market at this point from an interest rate perspective. And so, um, I wouldn't anticipate saying rates need to be lower than where they are today, just because this feels like it's more of a normal market. And you talk to somebody who's a couple decades younger, and they're shocked by that.
Yeah.
But rates, the interest rate world it's a much longer term than what a lot of us look at it as, and um, it feels like we're more in a normal range.
Yeah, I agree. And it's actually normal. I agree with that. And it's healthy. Now there's room to maneuver. So if there is some adjusting happening, the Fed can come in and manipulate the rates, right? If they're at zero like they were for all of those years, they're out of tools. So
Yeah,
what
there's
do
nowhere
you
you can go when you're at zero. There's only one way you can go.
exactly? That's a concern, right? So what I didn't think we were going to talk about the economy, but let's do this because now I'm interested in what you think.
Right.
What if you're not worried about a 2008 like recession, is there anything that you're worried about or keeping your eye on?
From a macro perspective,
Yes.
absolutely. Yeah. And so I would tell you there's a couple things, and right or wrong, and this will be apolitical, right? So what I would tell you is inflation is still very much a risk. Um, and I'm actually less concerned about tariffs, believe it or not. I talked to a lot of economists. Um, Tariffs are definitely could be inflationary, but it's temporary. It really is. It's really a blip on the screen. It's not something that's consistent. You know, we have um, we have an incredibly robust economy. We really do. And really, if it's more of a debt load thing. The debt of the country is actually a really big issue, and you start seeing, you know, one party is taking fairly drastic steps to try to, maybe overcompensate for that, or however they're trying to handle it. And you're going to have multiple sides that say this is wrong, but this is right, or whatever it may be. But I think we definitely have a spending problem from a governmental perspective in this country, and that's going to continue to put inflationary pressures. But the bigger issue to me is, and not to get too bankish on you, but you talked about printing a lot of money, and the Fed actually, I mean, post COVID, we were at $9 trillion that they had on their balance sheet, and that was from something that they called quantitative easing. So they were still pumping money into the system, right? And it was probably June of 22, 23, probably 22, that they started going, hey, we're going to start taking money out of the system. We're going to do something called QT, quantitative tightening, right? We're going to shrink the balance sheet of the Fed, right? Taking money supply out, right? And that should, in theory, start to, have some better impact on that inflationary number, which they've been doing. They've been doing it every month to the tune of about $95 billion a month, which is actually, fantastic. And the one scare, they'll call it, it's flashing amber, it's not flashing red. We have something called overnight funds, right? And so there's about $3.5 trillion with a T in overnight funds, and that is the banking system for money's moving, one way or another, right? And Jerome Powell recently came out and said, "Hey, we're good," um, but there are others that will tell you, "Hey, if you keep pulling money out of the system," and they do that by not reissuing treasuries. They do that by buying back, some of their debt. Um, and that number starts to shrink and shrink enough, you really don't have enough to actually do the things that you need to do. Now, they're not going to let it get to that point, but what they'll do is that quantitative tightening will start to slow. So they're not going to keep tightening it. And so if you do that, it's a form of easing, which you're then pumping more money into the system, which is inflationary. And so my macro concern, I guess, would be more of if something happens where we start losing jobs and we're having to start pumping money in at the same time, rates are going to have to go back up even higher. And the fear is something like what we had in the 80s, where they're going, we're going to kill inflation, we're going to kill all this right away. And the way we're going to do it is interest rates are going to go through the roof, and there are going to be a lot of massive job losses. And it becomes difficult to operate in the residential world when your residents aren't able to pay you because they don't have jobs, and everything else that they're trying to buy has become more expensive. And so you see little bits and pieces of that, but it's something that it's a unique teetering balance. And I mean, I know people that think that Jerome Powell is just a terrible, terrible person, and did this to the country. And I personally would tell you, I think he actually did a great job
I totally
what
agree.
he had, um, and he's continuing to do pretty great with what he's got. And it's just a different. It's a very delicate balance of the things that they're having to do. Did he react fast enough? I mean, you can say that about a lot of things too. Yeah, I mean, I'm sure he wishes he was reacting quicker than what he did. Um, but at the time, I know they have better access to you know, a lot more of the numbers than the layman does. And they see things a lot faster and sooner than we do. And they're able to try to do things from a projection standpoint. So, was this a slow landing as they say it was? I mean, it definitely feels that way. Everybody's going to be impacted slightly differently, but from a macro level, yeah, I mean, I think being able to kind of, keep this plane on the runway, so to speak, um, is pretty delicate right now, and you have a lot of competing forces, um, both good and bad, that can potentially derail some of that.
So you think rates may even go higher. So one thing I want the listener to understand here is that the Fed, what we're talking about here, has a dual mandate. So they need to keep inflation under control. So rising interest rates does that. That's one of the tools they use. Um, Quantitative tightening or easing is another. In fact, I should mention this. Quantitative tightening and easing has a higher impact on the 30-year mortgage or the 10-year treasury than the overnight rate that the Fed adjusts. So many people think that if they adjust rates down, then the mortgage rates are going to go down. But what we've seen recently is mortgage rates went up when the overnight rate went down. So we could talk more about that if you'd like. But one thing I want to just ask you about here, Sam, because you did such a great job of explaining how that money works at the macro level. Because of that dual mandate, if unemployment starts going up, I think I heard you say you think interest rates might go up,
No, no,
but
it's the competing powers, right? As unemployment goes up, right, they
right,
have to
interest
bring
rates would go
rates
down.
down,
Yeah,
right?
okay, got it. We're on the same page.
But it's that's why I say you have a lot of conflicting things that are going on. And as is, if they feel inflation is low enough, but you have, jobs lost starting to go, rates will have to come down. But right now, what you're seeing is we're fully employed effectively as a country, right? If you want a job in this country, in theory, you can go get one. It may not be the one you want, but there's jobs that are out there for really for everybody. Um, and so there really is no pressure, I think, to lower rates um,
Right.
any more than where we're at right now. And so um, I would say the bulk of the pressures that you see suggest that rates probably should be higher um, and going up. But that's just one man's opinion who just from the limited information that I get to see, and I probably do get to see a lot more than a lot of others. Just being on the board of a bank helps, and getting the financial resources that are available to us with that, and having a good understanding of um, really where numbers are coming in and what they're going to look like. But yeah, from a macro level, my fear is as interest rates go up, you have cap rates go up, and everything that we currently own becomes less valuable because the rate caps, which is the valuation that we're using on our commercial properties, will tick up as well, and that drives values down.
Yeah, okay, that's great. I'm gonna say this. I want you to explain the cap rate and the inverse relationship if you can for the listeners so they understand that. But prior to that, I was on a panel just yesterday to a room full of like financial analysts and bankers and just finance. And one of the other panelists believes interest rates are going down. I agree with you. I think if anything, they're going to go up. I think they're going to be rather sticky, actually. But if they move, I think they're going to go up as well. And I agree with the reasons you say. So I guess I just wanted to share that with you that we don't know, right? They could go up, they could go down.
Correct.
There's layoffs coming with in the federal government level. They're all over the place, right? People are getting these emails like crazy. I'm hearing about it. I know it's happening. I know there's a lot of leases being canceled. Of the 84-ish 100 leases the federal government has, they want to terminate 7,500 of those, which is absurd. I don't know how you even get there. Curious what you think maybe about that initiative, if we have time. But while we're on the cap rate thing, and this is something that I get pushback on sometimes and on the YouTube channel, and sometimes people will call me, they don't quite understand that. Help me understand, why would cap rates impact values?
Yeah, I mean, first of all, it's understanding what a cap rate is, right? And so the easiest way I could describe a cap rate, and this is more probably even from a banker perspective, is if I were to go and buy a building and pay cash for it, right? The cap rate of which I'm buying it is pretty much what they're telling me I can earn on that property if I paid cash for it, right? So if I went in and I bought something at a six cap, right? And it cost me $100,000. In theory, I should be able to make $6,000 a year after all the expenses and everything are associated with that. And when you use leverage, i.e., borrow on it, right? Your cap rate doesn't really change if that's what you're buying it at, right? But your thought is that, hey, using leverage, I'll be able to maybe juice my returns a little bit because I'm using other people's money to be able to do something like that, right? And if interest rates, which is a cost to the property, start going up, right? The cap rate, the value of that property, because of what it can pay out, right, has to move up a little bit as well because it's if you're going to keep those values consistent, you're going to have to raise the cap rate associated with the expense, which lowers the value of the property, meaning somebody coming in wanting to buy it, right, wants to get that same kind of return, right? Well, if the expenses keep going up, I've got to pay you less, meaning the cap rate's got to go up. And so there's really a consistent, they work together, but it's an inverse. It's kind of like a bond, right? As bond rates, go up, the value goes down. It's kind of the same thing, right? So for cap rates, as the expenses get more expensive, things of that nature, right? The values are going to change associated with that. And so one of the things that we talk about is as interest rates go, cap rates have a tendency to follow, not necessarily in kind, but if interest rates get more expensive, the cap rate's going to go up, the value of the property is going to come down.
Yep. Well explained. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. Okay, so you're a banker. We love bankers. I'm dying to know for the listener, bankers are vital to the success to real estate investors, especially as you grow into bigger assets like what you do. What do we do as a real estate syndicator or a real estate investor to help our chances of getting a bank excited about our deal?
Yeah, so there's a couple different things, because we borrow money obviously from a lot of different lenders, but what I would tell you is bankers are very similar from the standpoint of they're fairly risk adverse, they're going to be conservative, right? And they like communication. So one of the things that makes us good borrowers, and I mean this is a great example, right? Our portfolio here, we may have a storm come through, right? Before the storm comes through, we could be emailing our lender going, hey, just so you know, I know this hurricane's coming through right now. We have collateral. I want to let you know that we've already, we've cleared the gutters, we've cleared the drains, and we've battened down the hatchets, and we're protecting your collateral, right? And we're prepared for whatever comes this way. Send. And it's real simple, right? Okay. And that they're going to read that and go, okay, great, boom. And then afterwards, as long as nothing's happened, or if something has happened, you reach out to them again and you go, hey, you know what? Just want to let you know everything was good, no issues. Collateral's in great shape, right? I'm not even sending them numbers or anything with that. It's just, hey, everything's good. Or conversely, hey, we had some damage. Let me send you some pictures. I want to let you know the guys were on it right away. We had chainsaws taking down trees, whatever it may be. We're doing our best to make sure that everything is protected and correct. I'll let you know if we have anything or if it's even worth doing an insurance claim or whatever it is, but we're going to be working on this and protecting the collateral. Hence, they're our largest partners in the deal. And we're letting them know as the largest partners in our deal, what's going on with the deal. So communication with them and being just that kind of transparent makes us a better borrower because we're alleviating some things. They're not having to be nervous about, oh my gosh, I wonder if there's something, an issue there. They're not having to wonder about any of that. And you take that away. They like certainty. They really do. And they're wanting to know that you're doing the things to lower the risk associated with the property, whether that be before something like the storm in that example or after, right? And so, and we communicate a lot. We talk with them a lot too, just because we want to know, hey, we may have a deal coming up. What's your appetite for this? Or hey, what's the rate? What's your spreads looking like right now for this type of product? And so there's a lot more communication with them on an ongoing basis because we're treating them as a partner.
You mentioned the word appetite, which I love. And I know that bank appetites change
They do.
frequently. Help me understand as a newer investor, why does a bank like deals on one day and hate them on the next?
Yeah. So, well, all right, I'll give you a great example. As sitting on the board of a bank, right, I also sit on what's called the ALCO committee. ALCO committee stands for your asset liability committee. That's the balance sheet of the bank, right? And we meet fairly often, right? To sit there and go, all right, let's look. Let's look at the loans that we've done. Let's look at the deposits that we have. Let's look at the pricing for those. Let's look at the market overall. Do we want to take more exposure or less exposure? How is it with what we have? And so it's not necessarily that your asset class may be out of favor. It very well could be that your asset class we're overloaded on as a lender, and we do not want any additional exposure because we're outside of the metrics that we've set up for it. So it doesn't necessarily mean we're not going to do your asset class, but it could mean, hey, we've just got too much on our balance sheet associated with this. We're going to wait until either the bank grows as a whole or we get some pay downs associated before we're going to be willing to go out and do more. Um, and that's probably the easiest way I could describe that, because it's not necessarily um, the asset class, although there are some asset classes that are for sure out of favor, right? If you sit there and um, I would tell you, I wouldn't want us doing like C class office buildings, right, that are sub 60% occupied, because I don't know if that stuff can get turned around.
With
It almost
federal government tenants.
Yeah, yeah, exactly. Right? Something that you thought was for sure a for sure thing, right? But that has cancellation policies. Now you're concerned about that as a lender. There's exposure there. You're probably already meeting with your group and going, we probably need to put some additional loan loss reserves associated with these deals, because that's a system, that has changed and it's significant.
Yeah. So these are self-inflicted like ratios or buckets of assets to stay diversified, or
In
is this
part, yes. In part, yes, but in part, no. I mean, every lender, in particular if they're FDIC insured, right? They have governing bodies, whether it be the OCC as a national bank or your State Department bank, which is another governing body, right? Including the FDIC, who you're taking insurance on with. And so they're going to come in and look at everything you do every single year, right? Sometimes they'll go up to 18 months. It depends on the age of the bank, but they will look every single year, and they have guidance and ratios of which they guide you to. It doesn't mean that you can't go outside of it with appropriate mitigations and reasoning, but you know what you do as a bank or as a lender, where your sweet spots are and what you're going to be doing with it. And you also know you need to balance that risk evenly so that you're not outside your skis on certain things. Because if you look at some of the bank failures that we've had, say, in the last few years, right? Um, I would say the bulk of those didn't have anything to do with loans. They really didn't, but they got outside of their skis on the asset side of their balance sheet, going long for an investment that they really probably shouldn't have gone long in. Rates changed on them, and the value of those investments went down to a level where it depleted their capital.
yeah, exactly the same as cap rates? The
Mhm.
inverse relationship took down banks in 2023. Okay, so I wanted to ask you a little bit more about banking, then I want to get back into your story before we run out of
Okay.
time. But so I've borrowed money in the range of say 20 to 30 million dollars at a time.
Okay.
And when I get to that point, Sam, oftentimes banks will offer non-recourse, meaning they will not come after me personally if there's a problem with the loan.
Correct.
They'll restrict their recourse to the asset itself. Now, when I'm borrowing on a little rental property or maybe a small apartment building, and we're looking at 1,000,000 to whatever it is, it's almost always full recourse, meaning a personally guarantee. If I default, you're coming after me personally.
Yeah.
My balance sheet secures the loan. What is your bank doing with recourse? Because a lot of gurus out there say don't ever have recourse. It's always non-recourse. Go to a bank and don't personally guarantee. So, what are your thoughts on that?
Yeah. We're full recourse. The bank that I'm a part of, we're full recourse lender.
And
So
isn't that common though? Like, what's your
very
experience in
much.
banking generally?
Very much so. It's common. When you start getting into the bigger numbers, like what you're suggesting, a lot of banks they're syndicating out the loan, meaning there's a warm fuzzy level at which they're willing to go up to. And to do something like that, if it's a bank, the loan to values are going to be in an area where they feel extremely comfortable that if you walked away, they were going to be all right as well. And I would tell you, there's a warm fuzzy level, depending on how big of a bank you're going to, of what they're going to be willing to lend any one borrower. And so, even though they may have a legal lending limit, which they can go well above, it could be that they go, "Hey, at $20 million, that's the most we're going to be willing to lend." And if it's a $30 million loan, it doesn't mean that we won't do it. It just means we're gonna sell off 10 million of the loan to another lender, and they're going to come in and do the deal with us.
That's interesting. So syndication, we started off this whole conversation with syndication on your apartment building, your 100 unit there that got destroyed in a hurricane. You also syndicate loans, but tell me a little bit about the word syndication. What does it mean, and what is a syndication on an apartment building, which you're so
Yeah.
good at?
Syndications, it's really just a fancy way of saying we're pooling our cash together to go buy an asset. And so when we syndicate a deal, we put it out to our investor platform, right? And we'll say, hey, we need to go raise, let's just say we need to raise $5 million, right? And here are the parameters of what we're gonna, what we're gonna do and how we're gonna raise it. But we put it out to our platform and go, hey, we need to raise $5 million. And so we may have um, you know, 50 people all come up and go, all right, here you go. Here's $100,000 each. And that's going to be our syndication that we put together to go acquire the deal. And there's ways to do it, but really we do it under what's called a Reg D 506B raise. So that's the exemption that we use. And what it is, it keeps us compliant with the SEC. So we're doing a compliant raises to our group that we already have, established relationships with.
Yeah. So for the listener, the B is very unusual. You don't see a lot of those. It's mostly the 506C.
Yeah,
And the
the
reason for
C's
that
allow
is you
people to go out and
advertise.
spread
Yeah.
it to the world, and tell everybody, come join me, right? We keep things within our own group, and we invite people to join our group, but we have to establish a relationship because we want to know our investors are good to invest with, and that we would match up well. And being part of our deals, it's going to be something that it's going to work well for everybody.
And the B is you're allowed, because you're not advertising, no public solicitation. You're allowed to have some non-accredited investors.
We are.
So that's a
So
big
there's up
benefit.
to 30, you can take up to 35 what we call sophisticated investors, and that's an actual definition too. There's a list of things that you got to do to be considered sophisticated. Otherwise, it's an accredited investor that we're typically dealing with. And so
Okay. So define that for me.
yeah, so credit investor, easiest way I could describe it is $1 million net worth outside of your home, and you make either individually or with your spouse $200,000 if you're an individual, $300,000 with your spouse the last 2 years, and you expect to make that the following year. And that is really the kind of the broad definition of accredited. For sophisticated investors, it's you have a knowledge base associated with it. You may not have your $1 million net worth or things of that nature, but you have a great knowledge that you can prove up that you understand what you're doing to get into the deal. And there's also another caveat that you can't put more than, I think it's 10% of your net worth into a deal. So, if you have a net worth of $500,000 and you want to put $50,000, that'd be the max you'd be able to legally put into a deal if you're a sophisticated investor.
Yeah, and for the listeners' benefit here, what I find a lot of times, Sam, is people are accredited, they don't even know it. So that $1 million net worth requirement exclusive of your home does not mean it's exclusive of the things in your home. So
Correct.
if you have art and jewelry and furniture, all of that does go on the asset side of the balance sheet and improves your net worth. So if you consider the value of all your stuff, you very well may qualify. Um, and so I'm just pointing that out. I've seen a lot of times people think they're not, and they actually are.
Yeah, it doesn't mean you have $1 million in the bank.
Right. Yeah, exactly right. Okay, so if I was going to invest in a syndication, I actually have invested in many. Um, and there's some risks with that, right?
Absolutely.
The biggest risk, of course, is the sponsor group. So if you were going to invest your hard earned cash, Sam, into a syndication, what are you looking for to protect that money?
Yeah, so I mean, I think first it's actually understanding what you're getting into, right? I mean, I always tell people like you better read through the investment scenario. There's typically a PPM and a subscription agreement and an operating agreement that a syndicator should be providing you. And it's important to read through that so you understand the rules of how the entity is going to operate. If you have a comfort level with the sponsor, which I agree with you, is probably the number one thing that you're going to, want to actually do your due diligence on is the person, right? Because we always say it's appropriate to you want to back the jockey, not the horse, right? Because if something goes awry, you're going to want to know that that sponsor has your best interest in mind. They take on a fiduciary duty, meaning they need to make decisions that are in your best interest as an investor, right? But the other thing associated with that is what a lot of people need to know too is like if it's an apartment deal, these are not liquid investments, meaning there's an illiquid aspect to these. When you put your money in, you got to really sit there and go, I'm here for the long haul. I'm here for, the term of this deal, whether it be 2 years, 5 years, or 10 years, however long it's really going to take. You want to know that your money is in at that point and it's going to be secured into that deal. So these are not things that you're typically going to be trading in and out of if you're doing a syndication deal like that. And so, but I agree with you that sponsor is still probably the number one thing I would look at. And then you want to be able to do the deal. I have so many people that are new to it that will come and ask me, hey, I really want to get involved into a deal. I've got $100,000. What do you think I should do? And I'll ask them a few questions about what they are looking for. And I said, a lot of times they don't even know what they're looking for. They don't even know what type of investor they are or what they're trying to get out of with that money. And a lot of times I'll just tell them, look, it's okay to pause here, take a break, take some of that money and invest it in yourself. There are a lot of great educational content that's out there. There's great podcasts out there like Kevin. There's a lot of things that are out there where you can get educated, right? And learn a little bit more about what you're trying to accomplish with that money and then learn how to ask the right questions, who to actually do deals with. And there's so many meetups and things like that. And I would tell people, look, before you invest in anything, invest in yourself and just figure out what you're trying to accomplish with that. And then it's the appropriate time to, pull the trigger and go into deals.
I love that. I'll add one thing here. Everything you said is exactly right, and what I would do as well. And then in the operating agreement or the PPM, the private placement memorandum, you obviously want to know the profit splits, if there's any preferred returns coming to the passive investors or the limited partners. You want to see all of that. And then the waterfall, who gets paid first and when. So those are the obvious one, but a less obvious one, Sam, that I want to point out to the listener is the capital call provisions. This is one that I spend a fair amount of time trying to understand because it's very possible, especially in shaky environments like we're in now, where a deal might need additional capital. And where do you think the sponsorship group is going to go when it needs additional capital? Well, sometimes they'll front it. I know a lot of sponsors that will do that, but oftentimes, you guys, they're going to come to you, the passive investor, and ask you to put more money in. Just like if you owned a rental property and it got damaged in a hurricane, you might need to put in some cash to fix that property back up. So you're one
Yeah.
of the owners, you might have to put some more money in.
Yeah. And so what I would tell people, in particular when it comes to capital calls, we've been fortunate. We haven't had to do anything like that. But I would tell you, it doesn't mean that it's a bad operator or it's a bad deal.
No, I'm not saying that.
Um,
Please
yeah,
understand that
it
it's just some
absolutely is.
deals need that.
For sure, and in some cases, it absolutely makes sense to do the capital call if it's appropriate for, finalizing the business plan of what you set out to do. And so, and then there are some things where I would tell you it's, there's some guys that are there's definitely putting good money after bad. And people because of the distress situation they're in for whatever it may be absolutely should be selling instead of trying to feed the beast and trying to kick the can down the road if you will. And so that's part of the I guess the disclaimer where I said understand these are illiquid investments, right? When you're getting into them, uh that money's in there and it's not something that you can just easily just pull back out. There's distributions hopefully with many of these deals, so you could hopefully get money along the way. That would be it's a prerequisite for me to invest, right? But I would tell you it doesn't mean not all capital calls are equal and not all capital calls um, are a bad thing either, right? I mean,
Yeah.
there's definitely some times where no, it's very appropriate to do it in this particular scenario because it can enhance the returns, or it can push the timeline out to a more appropriate to where everybody can exit and do well. And so there's definitely times and places for them. Um, it's just it's become so much more prevalent because of the way a lot of people finance their deals and things of that nature, and particularly the assets that were acquired, say at the peak of the market in 21, 22, um, and some of the ramifications they've dealt with interest rates running up on them, and how that very much changed their pro formas of what they were projecting to be able to get.
Yeah, 100%. And I just want to clarify for you, Sam, and the listener, I wasn't saying they were bad.
Yeah.
I'm not saying they're good or they're bad. I'm actually not making an opinion there at all. My point is you understand the provision. And because here, let me give you an example of why I'm saying this. If you choose not to do the capital call, you have that prerogative, right? Then you're limited. Your liability is limited to your investment. That's why
Mhm.
they call it limited liability company. So you could potentially limit your liability to your $100,000 investment. But if you decide not to and everybody else does, the most likely outcome is you're going to get diluted. That would be the best case scenario. A not so great scenario, and I have seen this, is okay, we're going to loan you your capital call because you're not doing it at an 18 or a 21 or 25% interest. And so not only are we
Mhm.
potentially diluting your interest, but we're also bending you over because we're going to take an extremely high interest rate at your expense. And if it's in the agreement, that's what's going to happen. So not good, not bad. Just please understand that before you invest in a syndication.
Yeah, I've actually seen even worse ones where it's for those that do participate, their entire investment now will supersede on the payout scale those that didn't participate. And so you actually move down a notch in the payout order of things. And those that participated can be made whole. And you may be at the bottom, you'll be the last person paid out. And so if there's any deficiency, it's not an equally yoked thing anymore. And those investors that didn't participate um, could be in for a much greater loss when than those that did can cover not only what they put in, but their original investment as well.
It's pretty scary.
Yeah,
Maybe the advice here should be have your attorney review the investment documentation.
absolutely. No, I mean before you even get into the deal,
Yeah,
absolutely.
totally. All right, I gotta move on here because we're out of time. But here's what I want to do here, Sam. I want to go through my notes because I got a lot of notes. I
Okay.
learned an awful lot on this episode, so I want to read my notes back to you. What I'm taking away from our time here together, and I
All right.
want you to fill in any holes or any gaps, or if there's anything you want to add, please add them so I could write them down. And then while you're listening, if you could also think about maybe a last piece of advice for a real estate investor, and then we'll get your contact information. So we started off with your journey and how you started out with multifamily, and you like the multifamily asset class, even though you do other things as well, because it's a necessity. What we didn't talk about is the ease of financing. Multifamily is the easiest of the commercial asset classes to finance. The money is
Very
the
much so.
easiest to get, so that makes it attractive as well. You believe inflation is still a risk, it's not under control. And if inflation continues to rise or doesn't change much, we could potentially see rates go higher. So we had a nice long conversation about economics and the Fed and all of that.
Yeah, and I'll caveat this. Anybody who tells you that they know what interest rates are going to do, I'd probably run from that
Yeah.
person. Nobody really knows. And so that's just like I say, this is just my opinion, it's my feelings, my gut right now that we're probably in this kind of higher for longer period than what maybe a lot of other real estate pundits are saying differently from.
Well, recent reports, unemployment went down and inflation went up. So I think you might be on the right track here. We talked about cap rates, and then you explained how it's the inverse relationship to value. And the way you described cap rates is it's if you pay all cash for a property, what's the return I'm going to get? So I love that explanation. Um, Communicate with your banker. I asked you how should I build a relationship or get a loan, and you went right at the well. After you have a loan, make sure you communicate. So probably a good idea to communicate before and after, but
Very much
make
so.
sure that they know that their collateral is protected, and banks like certainty. And then we got into syndications. What a syndication is, it's a group. You use the number 50, but whatever the number is comes together and buys a bigger asset. So it's a way to all work together for a bigger benefit for everybody. And if you are going to do this, you got to stay safe. So how do you do that? Well, you read the documents, understand what you're getting into, and understand the people you're getting in bed with. That's my term, not yours, but understand the people that you are actually going to be investing in, because that's where the risk is.
Very
I'd
much.
go so far to say it might not be a bad idea if you don't know them well to get some kind of background check or something like that. Definitely Google search and use the word fraud and scam and all those really scary words with their name in the Google. That's something I do. Um, Understand that syndications is not a liquid investment. I love how you said that. Understand what you're looking for. And I'm going to close with this one because this is the best thing I pulled out of this conversation. If you have $100,000 and you don't really know what you're looking for, maybe you need to spend a little bit of that on yourself. Sometimes, this is what I wrote down word for word, sometimes a better investment is an investment in yourself. How'd I do, Sam?
Very good. Great. No. Yeah, I say, yeah, it's if you're going to invest in anything, right? It's okay to invest in yourself first, right?
I totally agree that there's no greater return on investment, ROI, than education.
Yep.
All right. What's a final piece of advice for our listener?
Yeah, I mean, if from a I would probably kind of carry on with what we were just talking about. There is just so much educational material that's out there. There's my gosh, there's more podcasts and YouTubes in the world for free. There's tons of books that are out there that I would, I'm an avid reader, and I would tell you jump into. And there's tons of meetups and education groups, and I would say, if you're looking to get into this industry, whether passive or active, um, that's literally probably the greatest way to do that, because you'll figure out real quick who the players are in the community where you're at. And there's so many conferences, throughout the country and everything. You can really figure out how to scale a business or keep it boutique the way you would want it, right? I mean, it's everything's in between. But I would just say continue with your education of it, and it'll make it a lot easier to do the deals.
Yeah, I love this. And I know we're out of time here. I just got to say this because of what you just said, but the conference thing, I get so much value from conferences, but it's not in the education. Surprisingly, it's in the people. So
Absolutely.
if you could find the
Network.
right group and you could start building relationships in a certain group where you see each other at the same conferences over and over, those relationships are like lifelong. And some of my best friends now, and we've done millions and millions of dollars in business, and I met them at those conferences. So sometimes they're a little expensive. So if you're on a budget and you're just trying to get educated, I agree with Sam. Podcasts, bigger pockets, books, those types of things, and then do the conferences when you're actually trying to build relationships would be my opinion. So how do we get a hold of you, Sam?
Yeah, easiest way, just go to our website. It's sunset-capital.com. Tons of material on there too, education and whatnot, but it's the easiest way just to email us. And we love talking to new investors, and we love talking to active investors too.
Cool. And we'll put that in the show notes. And I'm just going to mention this because we talked about the recession and then we talked about the 80s. So if you're interested in the 1980s and what led up to one of the only two in recent history recessions that impacted real estate values, that was actually 1990 coming out of the 80s. I wrote a report about that, comparing that to what we're seeing right now. That's totally free at thepinereport.com, thepinereport.com. So, Sam, you have a lot of different things you could be doing. I know you're doing a podcast several times a week. I know how much time that takes. You're on the board of a bank. You're on a committee for the balance sheet. You're doing syndications. We talked very briefly before I hit record about a deal you're working on right now. So I know you're super busy, man. And you gave me, oh, gosh, an hour of your time. So super appreciate you coming on and giving me your time like that. You
Absolutely.
did not have to do that. And for the
Yeah, great to
listener,
meet you, and great to spread the education that's out there, right?
yeah, this is such a great thing to be doing. It feels so good to help people. And so for the listener, I know you have other podcasts you could be listening to. You chose to tune in here with us, and I so appreciate you as well. If you got some value out of this episode like I did, 5-star review, share it with a friend, and I hope you make this day a great one. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.